Mr. Market here. If you don't like complicated math, you are not alone. Many people find the world of finance and investing intimidating because of all the numbers and formulas involved. But don't worry, you don't need to be a math whiz to make smart investments, but still want to invest. There are simpler ways to understand the stock market. One of the most useful tools for investors is the PE ratio. It's a straightforward concept that can help you make informed decisions without getting bogged down in complex calculations. Then watch this to understand the PE ratio. By the end of this video, you'll have a clear understanding of what the PE ratio is, how it's calculated, and how you can use it to evaluate stocks. So let's dive in. So what's a PE ratio? The PE ratio, or price to earnings ratio, is a key metric used by investors to determine the relative value of a company's shares. It's a way to measure how much investors are willing to pay for each dollar of a company's earnings. It stands for price to earnings ratio. This ratio is calculated by dividing the current market price of a stock by its earnings per share, EPS. It's a simple yet powerful tool that can give you insights into whether a stock is overvalued or undervalued. Imagine you're buying a lemonade stand. Let's say this lemonade stand is a small business that makes a certain amount of profit each year. You want to know if the price you're paying for the stand is reasonable based on its earnings. The PE ratio helps you figure out if the price you're paying is fair based on how much money the stand makes. By comparing the price of the lemonade stand to its earnings, you can get a sense of whether you're getting a good deal or overpaying. Here's how it works. To calculate the PE ratio, you need two pieces of information: the price of a single stock and the company's earnings per share, EPS. The EPS is the portion of a company's profit allocated to each outstanding share of common stock. Take the price of a single stock. This is the current market price that investors are willing to pay for one share of the company's stock. It fluctuates based on supply and demand, market conditions, and investor sentiment, and divide it by the company's earnings per share, or EPS. The EPS is calculated by taking the company's net income and dividing it by the number of outstanding shares. It represents the company's profitability on a per-share basis. If a stock costs $20, this means that the current market price for one share of the company's stock is $20. This price can change throughout the trading day based on various factors, including news, earnings reports, and market trends. And the EPS is $2. This means that the company earns $2 for each outstanding share of its stock. The EPS is an important indicator of a company's profitability and is often used by investors to assess the financial health of a company. The PE ratio is 10. Simple, right? This means that investors are willing to pay $10 for every $1 of the company's earnings. A PE ratio of 10 is often considered reasonable, but it's important to compare it to other companies in the same industry. A lower PE ratio might mean the stock is undervalued, suggesting that the stock is a bargain and may have potential for growth. However, a low PE ratio could also indicate that the company is facing challenges or has lower growth prospects, while a higher one could suggest it's overvalued. A high PE ratio might indicate that investors have high expectations for the company's future growth and are willing to pay a premium for its shares, but it could also mean that the stock is overpriced and may be due for a correction. But remember, it's just one tool among many. The PE ratio should not be used in isolation. It's important to consider other factors, such as the company's growth prospects, industry trends, and overall market conditions. Diversifying your investments and conducting thorough research are key to making informed decisions. Always do your homework before investing. Take the time to read financial reports, study market trends, and understand the fundamentals of the companies you're interested in. Knowledge is power, and the more you know, the better equipped you'll be to make smart investment choices. Now you know the basics of PE ratios. Happy investing! With this knowledge, you can approach the stock market with more confidence and make more informed decisions. Remember, investing is a journey and continuous learning is essential. Happy investing, and may your portfolio grow. Let's break it down even further with a real-world example. Imagine you have a lemonade stand that makes $100 in profit each year. If someone wants to buy your lemonade stand for $1,000, the PE ratio would be 10. This means they are willing to pay $10 for every $1 your stand earns. Now, if another lemonade stand makes the same $100 profit but is priced at $500, its PE ratio would be 5. This means the buyer is paying $5 for every $1 of earnings. Comparing these two stands, the one with the lower PE ratio might seem like a better deal because you're paying less for the same amount of earnings. But remember, a lower PE ratio doesn't always mean a better investment. The stand priced at $500 might have issues like poor location or bad customer reviews, which could affect its future earnings. On the other hand, the stand priced at $1,000 might be in a prime location with lots of customers, justifying the higher price. So when you look at PE ratios, also consider other factors like the company's reputation, future growth potential, and market conditions. This will help you make a more informed decision. Now that you understand PE ratios better, you can start looking at stocks with more confidence. Remember, investing is a learning process, and the more you know, the better decisions you'll make. Let's delve deeper into the significance of the PE ratio in different market conditions. During a bull market, when stock prices are generally rising, PE ratios tend to be higher. This is because investors are optimistic about future growth and are willing to pay more for earnings. Conversely, in a bear market, when stock prices are falling, PE ratios tend to be lower. Investors are more cautious and less willing to pay high prices for earnings, reflecting their concerns about future growth. It's also important to consider the industry average PE ratio. Different industries have different average PE ratios based on their growth prospects and risk levels. For example, technology companies often have higher PE ratios compared to utility companies because of their higher growth potential. Comparing a company's PE ratio to its industry average can give you a better sense of whether the stock is overvalued or undervalued relative to its peers. This can help you make more informed investment decisions. Another factor to consider is the company's growth rate. A company with a high growth rate might justify a higher PE ratio because investors expect its earnings to increase significantly in the future. On the other hand, a company with a low growth rate might not justify a high PE ratio. It's also useful to look at the company's historical PE ratio. Comparing the current PE ratio to its historical average can provide insights into whether the stock is currently overvalued or undervalued, based on its past performance. Additionally, consider the company's earnings stability. Companies with stable and predictable earnings often have higher PE ratios because they are seen as less risky. In contrast, companies with volatile earnings might have lower PE ratios due to the higher risk associated with their earnings. The PE ratio can also be influenced by external factors such as interest rates and economic conditions. For example, lower interest rates can lead to higher PE ratios because borrowing costs are lower, making it cheaper for companies to finance growth. On the other hand, higher interest rates can lead to lower PE ratios as borrowing costs increase, making it more expensive for companies to finance growth. Economic conditions such as inflation and unemployment rates can also impact PE ratios. It's important to keep these factors in mind when evaluating PE ratios. A comprehensive analysis that considers multiple factors will give you a more accurate picture of a stock's value. Now let's look at some examples of how PE ratios can be used in real-world investing. Consider two companies in the same industry. Company A has a PE ratio of 15, while Company B has a PE ratio of 25. At first glance, Company A might seem like a better investment because it has a lower PE ratio. However, if Company B has a higher growth rate and better future prospects, it might justify the higher PE ratio. In this case, the higher PE ratio reflects investors' expectations of higher future earnings. On the other hand, if Company A has stable earnings and a strong market position, it might be a safer investment despite the lower PE ratio. The key is to consider multiple factors and not rely solely on the PE ratio. Another example is comparing companies in different industries. A technology company with a PE ratio of 30 might be considered reasonable due to its high growth potential, while a utility company with the same PE ratio might be considered overvalued due to its lower growth prospects. It's also useful to compare the PE ratios of companies in different countries. Different countries have different economic conditions, interest rates, and market dynamics which can impact PE ratios. For example, companies in emerging markets might have lower PE ratios compared to those in developed markets due to higher risks. In summary, the PE ratio is a valuable tool for evaluating stocks, but it should be used in conjunction with other factors. By considering the company's growth prospects, industry trends, historical performance, and external factors, you can make more informed investment decisions. Remember, investing is a journey, and continuous learning is essential. The more you understand about the factors that influence stock prices, the better equipped you'll be to make smart investment choices. Now that you have a deeper understanding of PE ratios, you can approach the stock market with more confidence. Keep learning, stay informed, and make smart investment decisions. If you gained anything from this video, please like and subscribe for more.